Three people, the exact same starting line. They're all 30 years old. They all earn $75,000 per year. They all invest $1,000 every month. They all begin with the same amount of money. They all want one thing: to retire comfortably at 60. But 30 years later, one of them ends up with more than $1 million more than another, even though they earned the same salary and invested the exact same amount. Here's the strange part. The person everyone thought would win loses. The person who looked the smartest for years finishes last. And the person who looked almost boring the entire time quietly walks away with the biggest fortune. Hey, I'm Brian, and I spend way too much time thinking about why so many intelligent people accidentally make investing harder than it needs to be. If you're trying to build real wealth instead of chasing exciting stories, hit subscribe, because every week we break down the numbers that most people never stop to calculate. Today we're putting three investing styles head-to-head under identical conditions, and by the end you'll see why one of the most celebrated ways of making money in the stock market is often one of the worst ways to build long-term wealth. Let's destroy one of the biggest myths in personal finance. Before anyone says the comparison isn't fair, let's remove every possible excuse. Meet Smith, meet Carter, and meet Billy. All three are exactly 30 years old. All three earn $75,000 per year. All three live in the same city. They're in the exact same tax bracket. Each starts with the same investment account. Each invests $1,000 every single month without missing a contribution. Over 30 years, every one of them contributes exactly $360,000. None receives an inheritance. None wins the lottery. None starts a business. None gets lucky with cryptocurrency. They all retire at age 60. Everything is identical. Everything. Except one decision: how they invest. Smith becomes a full-time believer in day trading. Every morning begins with charts, news headlines, price alerts, and rapid-fire buying and selling. He believes constant action creates constant opportunity. Carter chooses swing trading. He still studies charts and market trends, but instead of holding positions for minutes or hours, he usually keeps them for several days or weeks. Less frantic, more patient, still active. Billy chooses the simplest approach of all. Every month, he buys low-cost index funds. Then he goes back to work. No predictions. No hot tips. No trying to outsmart the market. Just consistent investing. Three intelligent people. Three different strategies. One winner. Now let's see why the wrong person appears to be winning almost immediately. If you're new here and just subscribed, comment your name below. I read every comment and shout out new subscribers in my next video. I do appreciate you joining me on this finance journey. By the end of the first year, Smith has become the most interesting person in the group. Every few weeks he's posting screenshots of huge winning trades. Made $2,000 before lunch. Another perfect setup. This stock exploded exactly like I predicted. His phone is constantly buzzing with market alerts. His conversations are exciting. His stories are unforgettable. Everyone starts asking him for advice. In the group chat, Smith feels like the financial genius. Meanwhile, Carter has respectable results. He's catching larger market moves over several weeks instead of several minutes. His account is growing steadily, not spectacularly, but well enough that he feels confident he's found the perfect balance between active trading and long-term investing. Then there's Billy. Nobody asks Billy what he bought. Nobody shares screenshots of index fund purchases. Nobody gets excited because an exchange-traded fund quietly went up a fraction of a percent today. Billy's monthly routine is almost painfully boring. His investment account slowly grows. He contributes another $1,000. He goes back to living his life. From the outside, Billy almost looks like he's missing out. And that's exactly why so many people abandon long-term investing. Human beings are wired to notice excitement. We remember dramatic wins. We celebrate fast money. We assume visible success is permanent success. When one friend keeps showing impressive gains while another barely talks about investing, it's easy to believe the exciting strategy must be the better one. But investing has a dangerous habit. It hides the true cost of a decision until years later. And that's exactly what's about to happen. Around year 4, Smith experiences the year every active trader dreams about. Everything seems to work. Momentum trades, breakouts, earnings plays, quick reversals. He finishes the year with returns that absolutely crush both Carter and Billy. His confidence skyrockets. Friends begin asking if they should quit investing and just copy his trades. Even Smith starts wondering whether he's discovered a system that consistently beats the market. Then the bill arrives. First come the taxes. Because Smith is constantly buying and selling, many of his gains are taxed at ordinary income rates rather than benefiting from long-term capital gains treatment. A meaningful portion of his profits disappears before they can compound. Then come the trades that don't work. The market becomes less predictable. Winning streaks turn into losing streaks. A few emotional decisions replace disciplined ones. One oversized position wipes out several weeks of gains. Meanwhile, every single trade carries invisible costs. The spread between buying and selling prices, slippage during fast-moving markets, tiny execution costs that seem insignificant on one trade but become enormous after hundreds or even thousands of transactions. None of these costs make headlines. None appear in victory screenshots, but together they quietly drain the account year after year. Smith looks at the damage. He tells himself next year will be different. He studies harder, trades more, spends even more time watching charts. Instead of questioning the strategy, he doubles down. This is where the story stops being about opinions and starts becoming about evidence, because researchers have spent decades studying what actually happens to active traders, and the numbers are brutally consistent. One of the most widely cited studies, examining day traders over multiple years, found that fewer than 1% were able to earn consistent profits over the long run. That means more than 99 out of every 100 people attempting to make a living through day trading failed to produce reliable results. Another major study found that more than 80% of day traders lose money, and many quit within just a couple of years after repeated losses. Researchers have also observed that the most active traders often perform worse than investors who trade less frequently. In one well-known analysis, excessive trading reduced annual performance by roughly 6.5 percentage points, compared to a simple buy-and-hold approach. Think about what that means. Losing 6.5 percentage points every year doesn't sound catastrophic, until you remember that investing is built on compounding. A small annual disadvantage becomes hundreds of thousands of dollars after several decades. Now, what about Carter? Swing trading is unquestionably better than day trading for most people. Holding positions longer can reduce some trading costs. It can lower the number of taxable events. It demands fewer decisions. But Carter still faces problems Billy largely avoids. He still has to guess when to buy. He still has to decide when to sell. He still risks missing the market's biggest recovery days while sitting in cash or rotating between positions. And history has shown that missing only a handful of the market's strongest days can dramatically reduce long-term returns. Now, to be completely fair, there are people who succeed as day traders and swing traders. Some develop exceptional discipline. Some build genuine statistical edges. Some treat trading like a professional business, with years of training, strict risk management, and relentless execution. But that's the key. They're the exception, not the expectation. For the overwhelming majority of investors trying to build wealth over 30 years, the math simply refuses to cooperate. So why does Billy, the person who seems to be doing almost nothing, end up pulling so far ahead? Because investing isn't a game that's won by making the most decisions. It's won by making the fewest expensive mistakes. There are 4 mechanical reasons why Billy's strategy quietly compounds into a fortune. First, taxes. Billy rarely sells. That means he isn't constantly creating taxable events. Instead of sending money to the government every year, he leaves more of it invested where it continues earning returns on top of returns. His money compounds before anyone takes a slice. Second, friction. Smith pays spreads. Smith experiences slippage. Smith is constantly entering and exiting positions. Billy simply buys. The less money leaking out of the system, the more money remains inside the system doing the one thing that creates wealth. Compounding. Third, history. Billy isn't betting on finding the next winning stock. He's buying the market itself. He's letting thousands of businesses innovate, compete, fail, succeed, and grow on his behalf. He doesn't need to know which company becomes the next giant. He owns all of them. Finally, psychology. Smith has to be right over and over again. Carter has to make hundreds of good decisions. Billy only has to keep investing. No panic, no guessing, no revenge trading, no trying to predict tomorrow's headlines. Sometimes the greatest financial advantage isn't being smarter, it's making fewer decisions that can go wrong. And after 30 years, those tiny advantages don't stay tiny. They become enormous. Let's watch it happen. Imagine watching three lines on a chart. At first, they're almost touching. Then one begins to drift upward. Another starts flattening out. By the end, they aren't even on the same screen anymore. Let's look at the scoreboard. Year 5. Each person has contributed a total of $60,000. Smith's account is worth approximately $72,000. Carter has grown his portfolio to roughly $83,000. Billy sits at about $91,000. The gap is barely noticeable. Smith still believes one good year will erase it. Year 10. Total contributions reach $120,000. Smith climbs to approximately $153,000. Carter reaches about $198,000. Billy quietly crosses $256,000. Now people begin asking different questions. Billy hasn't been making flashy trades. So why is he suddenly ahead? Because compounding doesn't move in straight lines. It accelerates. Year 15. Contributions now total $180,000. Smith reaches roughly $236,000. Carter grows to around $336,000. Billy passes approximately $501,000. For the first time, Billy's portfolio isn't just ahead. It's in a completely different league. His gains are now generating gains large enough to buy what Smith contributes in an entire year. And Billy didn't work any harder. He simply stayed invested. Year 20. Total contributions reach $240,000. Smith grows to approximately $324,000. Carter reaches about $507,000. Billy climbs beyond $873,000. Notice what's happening. The distance between the lines is no longer growing gradually. It's exploding. Every additional year favors the investor with the largest existing balance. That's the real power of compound growth. Money begins earning more money than your paycheck can contribute. Year 25. $300,000 has now been invested by all three. Smith reaches approximately $413,000. Carter grows to around $674,000. Billy crosses approximately $1,295,000. At this stage, Billy's annual market growth alone can exceed what all three are investing over an entire year. That's when compounding stops feeling like mathematics and starts feeling like magic. Finally, year 30. Every one of them contributed exactly $360,000. No one invested more. No one earned a higher salary. No one got lucky. Smith retires with approximately $511,000. Carter finishes with roughly $812,000. Billy retires with approximately $1,778,000. Same starting point, same income, same monthly investment. One decision created a difference of more than $1,260,000 between first and last place. And the biggest surprise? The money isn't even the most shocking part of the story. Now let's calculate something people almost never include when comparing investing strategies. Time. Over 30 years, Smith spends hours every day studying charts, watching financial news, scanning for setups, managing trades, reviewing positions, and reacting to market moves. By retirement, he's invested roughly 60,000 hours into trading. That's the equivalent of working a second full-time career for 3 decades. Carter spends far less time, but it's still substantial. Researching companies, monitoring positions, planning entries and exits, reviewing market conditions. By the end, he's devoted several thousand hours, time that could have been spent with family, building new skills, traveling, or simply enjoying life. Billy checks his investments once in a while. He contributes $1,000 every month. He rebalances occasionally. Over 30 years, he spends roughly 120 hours managing his portfolio. That's not years. That's weeks. Read that again. The person who worked the hardest, finished last. The person who stared at charts the longest, built the smallest retirement account. And the person everyone called boring, retired with nearly $1,800,000 while spending only a fraction of the time. Now, does that mean trading is evil? Not at all. If you genuinely enjoy it, understand the risks, and treat it as both a skill and a hobby, there's nothing wrong with trading. But don't confuse entertainment with a retirement strategy. If you feel the urge to trade, consider limiting it to no more than 5% of your total investment portfolio. And if it's available to you and appropriate for your circumstances, using a tax-advantaged account, such as a Roth IRA, can reduce some of the tax drag on frequent trading. For the remaining 95%, Let boring do the heavy lifting. Because wealth rarely belongs to the person who makes the most trades. It usually belongs to the person who gives compounding the most time to work. If this breakdown changed the way you think about investing, let me know in the comments. Which strategy surprised you the most? And if you enjoy videos that replace financial myths with real math, subscribe and join us for the next one. Because in personal finance, the most exciting strategy often isn't the one that makes you the richest. The simplest one usually is.